Contribution and subrogation. The two final principles of insurance are corollaries of indemnity, which means they assist the achievement of indemnity. Let us go through each. This is the definition of contribution: the right of an insurer to call upon another to share the cost of a claim. At common law, the insurer from whom the insured seeks to claim must pay the loss in full. However, the contribution condition of a policy makes the contributory insurer only liable for its share, in which case, under this condition, the insured has to seek the balance of the claim from the other insurer. Contribution is the way an insurance claim is shared among insurers if such insurers are both covering and liable to pay the ensuing loss. The position of contribution arises when a policyholder holds more than one policy on the same subject matter. This overlap is quite common when there is home insurance overlapping with travel insurance, since certain items of property are insured under household insurance as well as insured whilst the policyholder travels abroad under the travel policy. These are the requirements for contribution to arise. The policies in contribution must be indemnity policies, not benefit policies. They must cover common interest, common peril must arise, common subject matter must be in question, and each policy must be liable for the loss, not necessarily in the same way. In fact, there are two ways of calculating contribution: the sums insured method and the independent liability method. The sums insured method is a simple method in which case the loss is shared in proportion to the sum insured. Take a look at this slide. Company A is insuring the property in question for 10,000 euros. Company B is insuring the property for 20,000 euros. Therefore, if there is a loss of 12,000 euros, then the loss of 12,000 euros is shared in proportion to the sum insured. Therefore, policy A will pay 10,000 division by 30,000 times 12,000. That is, the sum insured of A divided by the total sum insured of A and B times the loss. Likewise, policy B will pay the sum insured, which is 20,000, division by the total sums insured, 30,000, times the loss. And thus, policy B will pay 8,000 euros. This is the way the insurers in contribution would share the loss. When policies are not identical, another method is used to calculate contribution. This is called the independent liability method. In this case, we calculate contribution by calculating what policy A would have paid if it were the only insurer, and we would calculate what policy B would have paid if it were the only insurer dealing with the claim. Since both are subject to average and it seems that both are underinsured, as you can see, sum insured of policy A is 10,000, where it should have been 20,000, and the sum insured of policy B is 18,000, where it should have been 20,000. Both are subject to average, so the formula of sum insured over value at risk times the loss would apply. Applying this formula would result in policy A paying the amount of €225, policy B paying the amount of €450. That is what will be paid out. But if both had to pay out 225 and 450, together they would have paid out 675, which is greater than the loss incurred. This is, of course, not right. Therefore, contribution will step in and the total amount of the loss, which is €500, will be apportioned in the ratio of the independent liabilities, which means the ratio by which the €500 loss will be apportioned will be what A alone would have paid out, 225, and what B would have paid out, 450. Therefore, €500 will be apportioned in the ratio of 2:5:450. The last principle is subrogation. By definition, this is the right of a person, in our case it is the insurer, under a legal obligation to indemnify, has a right to make a recovery in the name of the insured. Let us take an example. If a third party causes damage to the insured's building, the insurer will settle with the insured. However, by virtue of the subrogation rights and the subrogation condition under the policy, the insurer can sue the third party who has caused damage in the name of the insured and subsequently make a recovery for the amount paid under the claim. This is an example which is very common and is one which arises out of the negligence of a third party. But it is not the only example. Subrogation could arise under a contract, as in the case of a tenant causing damage to the landlord. The tenant made liable to pay under the landlord-tenant contract. In this case, the insurer has a right to recover from the tenant. Subrogation rights may also arise under statute, as in the case of riot. For example, insurers have a right to sue the police who are responsible for civil order to make a recovery if, as a result of riot, the property of the insured is damaged. Lastly, insurers also can recover salvage. Once the insurers indemnify the insured, then what remains, that is the salvage, will belong to the insurer.